Good evening, everybody. Good late afternoon, and particular welcome to our shareholders. So very pleased to have you on the call, as well as non-shareholders. So I'm going to share my screen, and hopefully you will see the slideshow. Great. I think that's coming through. Mark, I guess I'm assuming it's coming through unless you told me otherwise. So, some quick introductions. I'm Louis Hall, the founder and CEO of Cerillion. So I founded Cerillion back in 1999 out of quite a large UK software house at the time called Logica. I was interested to hear earlier on that Mark actually worked at Logica back in the day in the 80s. So we have sort of fairly similar vintage. And Logica at one point was briefly in the FTSE 100. It had about 8,000 people at its peak and offices all over the world, and was a market leader in building bespoke solutions for across a very broad range of different markets. Quick introduction to Andrew, who you'll hear from later. Andrew joined us as CFO in February, replacing our previous CFO who'd been with us since 2002. So he's had a baptism of fire, so to speak, and is about to go through the year-end audit process. So that's an interesting start. He was previously a business called Vitec and did his accountancy training at Deloitte. So very pleased to have him on board. So on to Cerillion. So Cerillion, as I said earlier, was formed as an MBO out of Logica, a large UK software house, and we did the MBO because we believed that there was a future for software products in a market for business solutions that was very much dominated by bespoke solutions built to order. And at the time, Logica was doing very well in that market, and didn't really think that the products had a future, and hence we agreed that we would part ways. And it's quite interesting, obviously, in where we are today, where software products are ubiquitous across most market verticals, and software as a service is just a natural further extension of that direction of travel. But back in 1999, it was very much not the popular view that software products would dominate business solutions. So we then, after the MBO, raised private equity funding. Last of that was raised in 2002. And we used that funding to build a sales and marketing operation and to redevelop the software product set that had originally been put together in the early 90s. And then we raised no new money until 2016 when we did the IPO. And we did the IPO really for three main reasons. Firstly, we needed to exit the private equity investors who'd been invested for 15 years and were clearly at the end of their exit strategy. But also because we were very keen to progress with inorganic growth as well as organic growth. And by listing on the public markets, we thought we would have fairly ready access to capital to pursue M&A, and that was a key part of our strategy. But also, we also felt that being listed would raise our profile because we were starting to sign larger deals with larger customers, and I think having that additional transparency was becoming more and more important. And we were actually surprised at how big a boost that seems to have given us. It was a greater impact than we were expecting. So that was the sort of genesis of the IPO. So what we do is we provide the enterprise software layer to telecoms businesses right across the world. And roughly half of our revenue typically comes out of Europe. So Europe is our most important market, and there's a much greater diversity of types of telco business in Europe to play to. So that's a very, very important market for us. These numbers on the charts at the bottom are from our half year that closed, latest half year results. Half year closed in March, our financial year ended September. So in that first half of 22, our financial 22, Europe played a bigger part, but typically it's around half our revenue. with the other half coming from a mix of Americas, mostly the other half coming from a mix of Americas and Asia Pacific. Those customers are extremely important to us. As you can see from the chart, over 77% of our customers have been with us for more than 5 years. A lot of our customers have been with us for more than 10 years, and we have customers who have been with us for 20 years. So this software is, which I'll speak about in more detail in a moment, is very sticky. It's hard to replace. Once customers are on board, it's actually hard to lose them. As you'll see from the bottom right corner chart, over 90% of our revenue in that period, and this is fairly typical, came from the existing customer base rather than new customers we won in the current year. So that's, again, an important source of revenue for us. In terms of operating bases, we're based, our main operating bases are London, Pune in India, and Sofia in Bulgaria, which we started last year. And we also have some sales presence in some other locations. Moving on to a bit more detail around the product offering. So essentially, we provide a fully integrated end-to-end suite of modules that address all the key functions that telcos need to be in business, and that ranges from the tools that telcos use to build the products they sell to their customers, so complex bundles of fixed, mobile, broadband, TV services, whatever, through the modules that support the whole customer life cycle, from onboarding customers through CRM channels, through customer self-service, through dealer portal, through mobile apps and so on, through to the module that provisions those services onto networks, so talks to the telecoms networks and initiates those services, manages those services, through to the real-time charging platform that monitors customers' use of those services on an online basis, manages their balances and so on, authorizes calls, through to the revenue manager module, which puts those charges onto bills, manages receivables, collections, and handles revenue recognition and tax. And then we also have modules that support network planning. So our network inventory module manages where the plant is in the ground, in the air, whether it's base stations, antennas, cables, cabinets, whatever, and allows telecoms businesses to know what capacity they have at different parts of the network or different customer addresses. But it also allows them to plan expansion of the network, so that's a very important function. We also handle inter-carrier settlements, so when telcos are transiting traffic through other telcos, all that has to be accounted for and billed and reconciled, so we handle all of that. And we also handle data analytics, so providing telcos with a very powerful tool to allow them to slice and dice their data and look at different trends in the customer base and how that might lead to improving revenue and so on and so on. So it's a very deep and broad software set which we provide to our customer base. And in terms of how we provide that, we typically today provide that as a service. So we're providing for a fixed quarterly or annual fee the access to software over the internet, where we're hosting that in the cloud, and where we're managing and operating that service for the customer, and for that fixed fee they have it as a service, including license, support, and maintenance, and the whole stack. We can also provide that for customers who still want to have some sort of on-premise operation. We can provide it on-premise if we need to, but increasingly the trend is towards that software being provided as a service. In terms of customers, one of the big assets we have is that we can address any kind of telco. So our software suite will work with the vast range of telcos out there in the world. So that includes traditional PTT-like type telcos. So, for example, Telbrew over here is the main PTT provider in Brunei. So Telbrew provides standard telecom services, fixed mobile, broadband, etc., to its traditional customer base. And then we have different types of telcos. So, for example, virtual network operators. So, for example, Proximus, which is like the BT of Belgium, if you like, has an MVNO, mobile virtual network operator, that supports its main consumer challenger brands. So we provide our main suite of modules to support that business. So that's a different kind of telco. And then you have the energy businesses, for example, that also have telecoms businesses. So you probably won't have heard of Norlys, but Norlys is the second largest energy power provider in Denmark, but it's the largest provider of TV and broadband services in Denmark through a number of different telco brands. So we provide our full suite of modules to support that business. Another different kind of business also in Denmark is that we support the wholesale broadband company that essentially integrates the broadband service providers, whether they're Tele Denmark, Norlys, whoever else, with the infrastructure owners, and that's a complex partner management solution that enables all of the exchange of revenues between those different players to be managed. That we can also support, again, a completely different kind of telco. And then there are telcos that are kind of not really telcos, like Liquidity, for example. So Liquidity is actually a message aggregation transmission platform that will deal with things like, for example, the Eurovision Song Contest. So when everyone votes in the Eurovision Song Contest, all those messages have to be collected, billed, reconciled, and so on. And our software supports that business as well. And then you'll have something like Astrid. So Astrid is the Belgian Emergency Services internal network. So this solution supports the billing of telecom services, radio services, etc., to all of the fire stations, police stations, ambulance stations, and so on in Belgium. So again, a very broad range of different types of telco that we can sell into, which significantly enhances our range. We also have a few, whilst the majority of our revenue comes from telecoms, we do have some customers in other utilities. So for example, power and water, where we support those customers, it's just with our network imagery module, but that's an interesting other stream of business. And we also have a flavor of our solution that is designed for pure subscription billing, where we support businesses like, for example, G4S, which is the big UK cash management business. Again, this is completely different to telecoms, but it's another application that we can turn our software to. So why do customers buy? What are the drivers in the market? And essentially, what would cause a customer to either replace their existing stack with our solution or upgrade our solution once they have it in place? And I think I'm not going to go into all the detail here, but there are essentially three key drivers that we see. Revenue growth is obviously a key one. And this is where, for example, telcos need to monetize their enormous investments in fiber rollouts, which we're seeing at the moment, and also 5G infrastructure, by looking at different ways to bundle products, different ways to personalize products, etc., with more sophisticated enterprise software tools that overlay those networks. And you know, that's one of the reasons that telcos will look to buy new enterprise software stacks, such as the one that we provide. Obviously, operational efficiency is key. So if you can consolidate systems, so lots of the bigger telcos might have 10, 20 different systems to handle billing, CRM, etc., for different services that have just grown up over the years. And if we can consolidate those onto a standard platform that can support any service, any kind of telco, such as the one we have, then you can have very large savings of OpEx. But also, time to market is very important for telcos. So traditionally, legacy enterprise software systems, what we call BSS, OSS in the telco world. If you want to introduce new product to market, that may take 6 months of software tweaking and all the rest of it to get a new product to market. With standard product tools like the ones we provide, you can do this pretty much overnight, but by using a GUI rather than having to get software engineers to hack into databases or to change software. So having products that are not just automated, but also fully integrated is a key part of enabling telcos to get new products to market quickly and react to changes in market conditions, which is obviously increasingly important. And then finally, technology. I mean, technology, there are always new ways of technology coming through telecoms. You know, when I started out in this business, we were at 1G, now we're at 5G, we're talking about 6G. 7G's been mentioned. Nobody really knows what's in 7G, but you know, there'll always be another G. And that will continue to drive change. Change drives business in our world. Looking at the market, we attack different parts of the market in different ways. So for the biggest telcos in the world, the tier ones and the larger tier twos, we're looking to sell in point solutions, or where we sell one or two of our modules rather than the whole end-to-end suite, or we're looking to sell most of our end-to-end suite to particular brands in a big group. So if you look at some of these examples, KDDI, one of the world's largest telcos in Japan, we provide KDDI with our network inventory module, but we don't support their main charging, billing, and all the other functions. Proximus in Belgium, I mentioned earlier, we don't support the whole of the Proximus business in Belgium, Netherlands, and Luxembourg, but we support their main consumer challenger brand in Belgium. And then if you take Liberty Global, for example, another one of the world's largest telcos, we don't support their European and North American businesses, but we support a lot of their Caribbean and Latin American businesses, where we provide, again, most of our software suite. So there are lots of different ways we can interact with the market. For the tier twos, the mid-sized to smaller tier twos and tier threes, we're typically supporting all of their services, all of their bases with all of our modules. And that would be, for example, a Telbra we spoke about earlier on. And I've spoken briefly about some of the other verticals that we support. So we can support pretty much any other vertical with basic subscription billing, as we do within healthcare and financial services and so on. In terms of channel partners, so Nokia are an important channel partner for us, mainly in that they enable us to access markets that would be hard for us to reach on our own. So, for example, in the Middle East, which is hard for small business to operate in, Nokia have enabled us to win a very important new contract that we're currently implementing at the moment, and we expect more to follow from that channel. GE Software, not famous for software, more famous for jet engines, but they have a very large software division, and they sell our network inventory module through their as part of their, alongside their digital mapping tools. So that's another important channel for us. And then we work with some of the major systems integrators out of India, Europe, and North America. So channels are important, although it's fair to say that most of our sales are direct at the moment. Competitive landscape. So our main USP in this market is that we have a product solution. It works out of the box. It's already fully integrated together. We're not cobbling together different solutions from different vendors with lots and lots of integration overlay over the top. And this can be deployed very quickly. So it might not sound quick, but we can deploy a solution in between 9-12 months. Some of the biggest solutions, sometimes 15 months. But that's much faster than most of our competition, which is starting with a product framework and then building a bespoke solution that will take multiple years to implement and get into service. This is also a much cheaper model. So for providing standard products, where the same product is provided to every customer, we can do that much more cost effectively. So typically we're doing that for a low number of tens of millions of dollars, whereas our larger competitors are looking at $100 million plus type deals, where they're doing a huge amount more services work, which inflates the price. This also makes it, our product approach, where every customer has the same software, makes it much easier to upgrade those solutions as we go forward. Whereas if you take a solution from a vendor that has it's created a bespoke one-off for that particular customer, that's much harder to upgrade. And equally, if you take a solution from multiple vendors with different modules being provided by different vendors, that's almost impossible to ever upgrade. And in terms of how the competition breaks down, I mean, we compete with the large independent software vendors. So the likes of Oracle, for example, Amdocs, a big Israeli business that's has the most, is the largest provider in this space, and not the largest company. You know, we compete with those players on the basis of having a product solution, time to market, and far more cost effective. Also more cost effective, as I said before, in terms of long-term cost of ownership. And then we have the network equipment vendors. So those are the big telco players, Nokia, who are partners, they're not a competitor. Ericsson, who do have a software suite in this space, enterprise software layer similar to the one that we have. It is built mainly from quite legacy software, so it's not as competitive as our software on a straight comparison basis. But obviously Ericsson has a very large telco customer base that they can leverage, so they are a competitor. And then you have the Chinese players, ZTE and Huawei, who are excluded at the moment from our main European and North American markets, so are much less of a problem than they were a few years ago. And I think that has helped us quite a lot in recent years. And then there are some smaller independent software vendors, but they tend to be more kind of our scale, but they tend to be focused more on particular kinds of telcos or particular regions. And then finally, just a point on the analysts. It's very important that we're covered by the main telecoms analysts, particularly Gartner. So a lot of business comes to us directly or indirectly through those channels. So we're very highly rated by Gartner. We're well rated in their Magic Quadrant and so on. So you know, that does help enormously with driving the opportunities. Just a quick look at the some numbers. I think that these figures are based on as I said before, on the 6 months trading to March 22, so the first half of our financial 22. I think the most interesting thing from a trading point of view about the business is that it has switched from a business that was growing at 9 or 10% a year since IPO in last year to a business that's growing at 25% a year. And we've also seen, in line with that, some step changes in margins. So we're now trading at around 78% gross margin and 40% plus EBITDA margin. So that's a significant transformation. What's driving that? I think the chart on the right-hand side, we're seeing ever-increasing size of largest contracts each year. And these bigger contracts are massively important because they tend to be with larger customers, deeper pockets, broader ambitions, also tend to have larger customer bases, larger end user bases. And our software as a service fees are based directly related to that number of end users. So if a telco has 1 million mobile subscribers, then it's 1 million times X a month or a quarter or whatever. If they have 2 million, then it's 2 million times X. Also, the larger telcos are more likely to want to have an all-in SaaS deal, and those SaaS deals themselves have a lot more in the bag. So we're not just providing software license, implementation and support and maintenance. We're also doing the hosting, we're doing the management, operation of the solution, and so on. And those also have much more recurring revenue. So that I think those factors are a key part as to why we've managed to flip the growth curve. And we're talking some detail now about the numbers, but we essentially hit record highs across most of the financial measures. Big increase in net cash. Just on sales, we had strong sales to existing customers in the first half. We didn't have strong sales to new customers, but we did have a big jump in the new customer pipeline in the first half, up 31% to 172 million. And the second half, we've already announced that we've closed 15 million pounds of that with a big new customer win announcement a few weeks ago. And I think it would be reasonable to say that if you added that to the 11 million that we recorded with existing customers in the first half, we would be likely to at least equal, if not exceed, our 33 million sales new orders result for last financial year, which in itself was a significant jump from 23 million the previous year. So all that suggests that we're well positioned going into not just this year end, but the next 12 months as well. Okay, I'll hand over to Andrew, who's going to talk a little bit more detail about these numbers. Andrew.
Thank you very much, Louis. So this chart shows the KPIs for full year 2021. Starting at the top left-hand chart, as Louis was saying, you can see that between 2016 and 2020, revenue was growing at around 10% a year. And then since then, in 2021, we have seen this step change in performance with an increase of 25%. And again, in H1 22, we saw further revenue growth of 26% in that period. The chart in the middle again shows the recurring revenue run rate. As Louis has said, since 2016, the recurring revenue run rate overall has grown at a higher level than for total revenue. And this includes very strong growth for the managed services revenue, which you can see in the chart on the far right-hand side. Looking at the back order in the very center of the chart, you can see at the end of 2021, the back order was £42.1 million. This is made up of two components. First of all, £34.9 million of sales contracted, but not yet recognised. In addition to that, £7.2 million of annualised support and maintenance revenue. So this really helps to underpin future revenue and provides us with good visibility of the future as these orders get converted into revenue. I think an important point to note is that this back order does not include the impact of term license renewals. So typically when we sell new contracts to customers, they buy a license under a 5-year contract. At the end of that 5-year term, we would expect them to renew the contract, and therefore we would continue to generate incremental revenue sort of in these blocks. So this additional revenue has not been included in the back order and provides further upside to the number that you see here. On the far right-hand side, you can see the impact of net cash. So this has increased significantly from IPO in 2016. At the end of in the half-year results, we reported net cash of £16.5 million. So again, above the value that you see here. And also, we don't have any debt left on the balance sheet. So this was the borrowings were fully repaid last year. So we are now debt-free. So what you see here is cash that we're holding on the balance sheet. In terms of the bottom line here, the adjusted PBT and adjusted EPS, again, you can see there was a step change in performance from 2020 to 2021. And I think that really shows the impact of strong operating leverage with the incremental revenue falling through to profit. I think that was partly masked by slightly lower operating expenses due to the impact of COVID, for example, lower travel costs. But even so, you can see a very strong impact of strong operating leverage in the business. Finally, on this slide, bottom right-hand corner, dividend per share. You can see we have a progressive dividend policy from 2016 to 2021. Dividends have increased at a compound annual growth rate of 12.7% per year. Part of our strategy is to continue to pay out a proportion of our free cash flow to investors through dividends. So turning to the next slide, I think the key point about the business is we have a very good track record of revenue growth, high margins, and good cash performance. And this is really demonstrated in the strong financial performance that we reported for the first half of 22. So just looking at these results, you can see the increase in revenue of 26%, adjusted EBITDA increased by 50% to £7.2 million. And you can see there was a significant increase in the net cash balance to £16.5 million. Looking at the table, you can see that the increase in revenue was mainly driven by services due to the implementation of a number of major projects. At the same time, the software revenue was slightly lower due to the timing of license recognition. Now, given that license revenue drops all the way through to profit, so incremental license revenue, the operating leverage is very, very high because there's no associated costs with it. Under this scenario, you might have expected the gross margin to fall in a period when the software revenue falls. But what actually happened is we were able to maintain the gross margin at 78.5%, which was in line with the first half of 2021. And this was really because we benefited from focusing our recruitment efforts in India and Bulgaria, where costs are significantly lower versus the UK. So by doing this, we were able to reduce our average cost per head. And by doing so, we managed to offset the impact from the change in revenue mix that you can see here. Looking at the adjusted EBITDA margin, that increased to 45% in the first half. Again, this shows a strong operating leverage in the business. So whilst the revenue grew strongly, we managed to control our costs, and that helped to boost the margin to 45%. And finally, as I mentioned, we have a good history of cash performance, which continued in the first half. This enabled us to declare a dividend of 2.6 pence per share, which was up 24% on the first half of last year. So turning to the next slide, there's really just 3 additional points to mention here. First of all, we continue to invest in R&D. So over the full year, we expect to invest around 10,000 days in developing our products. In terms of costs that we capitalised 0.5 million pounds worth of development costs in the first half of the year. This was approximately equal to the amortization charge. So overall, there was no net benefit from an accounting perspective. Second point, in terms of the depreciation amortization charge of 1.5 million pounds, this includes £500,000 amortization of acquired intangibles. This stems from the IPO, and the balance will be fully amortized by March 2023. So going forward, we would expect this amortization charge to be significantly lower. And finally, as we had anticipated, the effective tax rate increased from 12.9% up to 14.2% in the first half. And this was really driven by, first of all, the increase in the profit, and secondly, the fact there was no further benefit from brought forward losses, which were fully utilised in the prior year. So now looking at the balance sheet in a bit more detail, I think the key thing to note here is that the balance sheet is very, very strong. As we said before, there's cash of £16.5 million. We don't have any debt, and there was a significant increase in net assets of about 34% versus the prior period. Just looking at a couple of the key balances, the intangible assets balance of £3 million is broadly made up of £2 million of capitalised development costs and £1 million of acquired intangibles. Again, you can see that balance had reduced from £1 million from the prior period, and that is due to the amortization of the acquired intangibles, which will be fully amortized by March 2023. A couple of other points, you can see the right of use assets and liabilities. These relate to accounting for leases under IFRS 16. And the final point on this slide is you can see that we continue to control working capital very closely in order to maximise our cash performance. So finally, looking at the cash flow statement, again, thinking about working capital, you can see from rows 2 and 3 in the table above, in the first half, there was a net increase in working capital, a favourable movement in working capital. And this was due to the focus on cash collection and the timing of invoices. As we continue to grow the business, we would expect to invest in working capital. So we would expect working capital to be an outflow of cash, but in the first half, there was a slight benefit. Looking at the net cash from operating activities, that was £6.5 million in the first half. And you can see out of that, we were easily able to afford the £1.5 million worth of dividends, the £0.7 million net employee incentive shares, which was to fund the Save As You Earn programme to incentivise our employees, as well as £0.4 million of lease payments. So putting all of that together, that gave us a closing net cash balance of £16.5 million. Back over to you, Lou.
Thanks, Andrew. So just a quick look at the sales numbers. As you can see, as I said earlier on, we saw a jump in our perspective, new customer unweighted pipeline. This is the chart, the top right-hand corner here, from 131 million at the end of the first half of 21 to 172 million at the end of the first half of 22. And we've already seen, as I said earlier on, 15 million of that bulge convert but that clearly, the growth in the pipeline is encouraging and gives us a lot of confidence going forward. We also measure, we also maintain a pipeline of new business with existing customers, and these are much shorter sales cycles because the customers are already here as opposed to new customers we're trying to win. But even here, you can see a very healthy jump in the pipeline for existing customers. And then we weight the probability of closing the total amount of these deals down here in the weighted charts. And what we're saying here is of that 172 million at that point in time, when we add up the probability of closing each of those deals, we get a total of 35 million that we would expect to close from the 172. It's not an exact science, and this stuff does fluctuate all the time from month to month. But suffice to say, it's a healthy number compared to the revenues that we're forecasting going forward. So finally, a quick summary. I think we've covered most of these points, but just to conclude, that large contract win back in July has significantly enhanced our order book, and I think that, coupled with the strong growth in pipeline that we saw at the end of the first half, gives us a lot of good visibility of forward revenues that we've discussed. And just a few words on people. We haven't really spoken much about people. As Andrew said, we have managed to reduce the average cost per head by diverting roles to India from UK, for example, but also employ more people in Bulgaria, which is a new operation we opened last year. And that's been very successful. That's grown to about 25 people already, and we expect to carry on growing that quite rapidly next financial year. We're also branching out into other locations in India. So Pune is actually now quite a hot location in terms of recruiting talent. So we've opened an office in Ahmedabad in Gujarat, which is what we would refer to as a tier 3 city, which is less overheated, and that's been very successful so far. I think there are about 18 people employed there now. And we've also opened a small operation in Indore, and also in India, and we have about 6 or 7 people there, and we're gradually building that centre. So we're looking at different ways of flexibly recruiting people, trying different locations to manage the talent challenge that's out there, and to contain not just labour costs but churn. So, I mean, in summary, I think we're well positioned. As Andrew said, the balance sheet is strong cash position. We're well positioned for M&A, and yeah, we're all set to go forward. Thank you very much.
Thanks very much, Louis and Andrew, for a very interesting, comprehensive presentation. I'd just like to remind delegates, if you'd like to ask a question, click on the Q&A button at the bottom of your screen, and you'll be able to type your question there. We have a couple of questions from delegates to begin with. Bruce asks about liquidity, pointing out that 77% of shares are in the hands of major shareholders. However, I would say, looking at the Stockopedia data, the 3-monthly average daily traded volume is about 70,000 shares, representing a value in the region of 700,000 sterling traded daily, and it looks like the bid-offer spread is only about 1%. Nevertheless, to ask Bruce's question, are you concerned about a potential lack of liquidity in the shares, and do you have any plans to address this?
Yeah, so I'll say 2 things. The first is, I think that position has improved quite a bit recently, because we've seen Miton, who are one of the founder keystone shareholders from the IPO, and we originally had about 18%, I think, and we've seen Gervais Williams sell down all of that holding, so that was released into the market. We've also seen Gresham, again another keystone investor, who had about the same 18% or so, sell down some of their holding. Top of my head, I can't remember, but I think we do have it in the presentation here. Yes, they're down to 12.2%. Canaccord picked up a fair amount of the Miton holding, but again, they've also reduced from a peak as well. So I think we're seeing a much better picture in terms of liquidity in recent months. And then the second point I'd make is that we do expect to do M&A. We spend a lot of time looking at other businesses to buy, to add to enhance the mix, to build out our product portfolio into some more subsidiary areas where we don't have to have a solution in that area, but we could sell that solution into the existing customer base if we had it, and vice versa, bring in new customers that we could sell our existing product lines into. It's been quite challenging over the last couple of years, not just the COVID thing and the inability to travel and meet companies, but also the valuation has been very high. But we do see that as a way that we would increase liquidity, because we would inevitably look to place stock to fund those acquisitions, as well as using cash on the balance sheet. So sorry, that's my long-winded answer to that question.
No, thanks very much, Louis. And I guess that's why the Stockopedia figures reflect a rather better picture than that might be suggested.
So. Yeah.
I would just, you mentioned that you may wish to place shares. From ShareSock's point of view, can I just stress that we very much welcome open offers to existing shareholders, so that they have an opportunity to invest on the same terms as any new investors. So I hope very much you'd consider that type of route.
Yeah, no, I think absolutely. I think that's I'm not an expert in these matters, but I'm sure that's what we would do.
Excellent. Thank you, Louis. Moving on to a question from Steve Lowe. Well done on negotiating larger and longer term contracts. In a higher inflation environment, typically what clauses are written into those contracts to allow you to pass on inflationary cost increases?
Yeah, so the term part of those contracts, which is all of it except initial implementation project fees, they have inflation ratchets built into them, so that we're index linked to inflation essentially. Typically UK inflation, but we sometimes use international measures depending on where the customer's based.
Right, thank you. And I think that really answers.
Good point.
Yeah, I think that really answers Andrea's question as well about inflationary headwinds. So obviously you will face higher employment costs, but you are able to pass those on. Is that correct?
No. I think just a second point on that is, whilst we are facing higher inflationary costs, by recruiting more people, a greater proportion of people in India and in Bulgaria, we are able to overall sort of mitigate the impact of inflation, because costs in these countries are significantly lower versus the UK.
Yes, of course, that makes a lot of sense. Talking about the staff in those lower cost locations, India and Bulgaria, are they mainly software developers, or are some involved in sales?
So, well, in the India and Bulgaria locations, we have a lot of software engineers, but we also have services people, consultants who go out and deliver projects to customers. We have sales distributed in other locations. We do have some sales in India, but we don't have sales in Bulgaria at the moment.
Right, thank you. A few questions that I had whilst we're waiting to see whether any other delegates wish to ask any questions. Can I just ask what proportion of your revenues are from software as a service business, roughly?
I think that's one for you, Andrew. I'm not sure we actually disclosed that particular detail. We look at it different ways.
Yeah, so I mean, in the first half, the way we disclosed it in our report is we kind of stripped the revenue between software, services, and third party. So the software element was 31% of the total revenue.
And does that represent traditional licenses, what you refer to as the software element?
Yeah, so that's made up of license revenue as well as software and maintenance revenue as well.
But the thing here is that some of the services revenue is software as a service revenue, which is recurring, because that's the revenue involved in, that's a slice of the SaaS fees involved in managing, operating the solution, and then some of the third party will be hosting of those solutions.
Right. Okay. Then I'd just like to ask a little more, if you could say a little bit about your sales and marketing operation. That would be quite interesting, I think.
Yeah, so I think, as I said earlier, most of our sales, the majority of our sales are still direct. I think we've seen a sea change in the way the market works, in that, you know, when you and I were in Logica market, so software products were sold by partners, by channels, such as there were software products in those days. And certainly, you know, if you go back 10 years, it was the normal process was small independent software vendors would pony up with a range of big global brands, and the big global brand would do all the sales. But what we've seen in the telecoms market is that telcos increasingly want to work direct with the end vendor, and this is very much affected by the software as a service revolution. So with software as a service, it doesn't make sense to have your as a service solution from, you know, IBM if the provider of the service is Cerillion. So we see a much more direct relationship between customers and vendors than we have done historically. So, but we have a global sales team, based everywhere from Australia to London. And you know, it's not a huge team. We have about 20 people in that team, but we are able to service a very broad range of opportunities with that team, mainly because telcos are pretty much the same wherever they are. So we don't need a different regional person to understand how a telco works in Australia or in Africa or in India compared to how it works in North America or Europe. So that enables us to get high degree of leverage from that same central team.
Thank you. And what would you estimate is the proportion of your addressable market that Cerillion already serves?
I would say we don't, and it depends which addressable market, total market size numbers you go off. But you know, the total market by some estimates is 15 to 20 billion a year. You know, obviously we're a fraction of that. So, and then of course, we wouldn't necessarily be able to address the whole market. So for example, we don't do business in China. But I think, you know, it's probably less than 2%, depending on which estimates you go with. So
lots for your sales team to go at.
Yeah, absolutely. And I mean, sorry, to go back to your question on sales, we operate a combination of inbound and outbound tactics. So a lot of stuff just comes to us because it's a very, very small world in enterprise software for telco. Been around a long time, good reputation, touch wood. And but we also run outbound campaigns. We go to major industry shows and events to generate leads. We do all of the usual you know, cold calling, lead generation activities, and so on. So it's a mix of inbound and outbound.
Very good. You've done very well in turning a lot of your profits into cash, as you pointed out. Your cash has grown considerably. You mentioned you were looking at acquisitions. I suppose that's one possible use for the cash. I was going to ask what uses you have in mind for that cash.
It's a good question. I mean, the main use would be M&A. You know, we're funding R&D through normal business operation mostly, but obviously to the extent that we want to do something more adventurous, then we have got the scope to capitalize more and have the cash to support that. But you know, that obviously depends. If we don't do an M&A deal for another year or so, then we'll have a cash issue where we may have to look at special dividends and so on. That wouldn't be our priority.
I think another point on the cash is it's it's very helpful to have a good amount of cash on the balance sheet. So when we're looking to take on larger deals, it's good to have the cash in order to be able to fund the potential working capital investment.
Yeah.
So the way that our business works is under IFRS 15, you typically recognise the license element up front, but the customer will typically sort of pay over sort of 5 years. So there should be some sort of element of working capital investment. So having the cash is very helpful to be able to fund that.
Right, thank you.
Yeah.
A couple more questions have come in. To a certain extent, you've just answered a large part of the first question, but in terms of growth opportunities, what do you have a rough idea of the sort of proportion that are likely to come organically versus what you might get from M&A? That's a very difficult question to answer.
Yeah, I think when we first did the IPO, we did think that most of the growth would come from inorganic, because we IPO'd with a market cap of 22 million, and we couldn't see how we got to 50 million market cap without some inorganic activity. But I think the big change we've seen in recently in terms of the growth rate and the speed at which we're expanding, and the increase in the market cap, have made M&A something we see less as transformational and more as kind of tactical. So we would expect growth to come from M&A, but we still expect most growth to come from organic expansion, if you see what I mean.
Yeah, that's good to hear. I mean, from the investor's point of view, it tends to be less risky. So,
yeah.
So the type of acquisitions you have in mind would be what we generally call bolt-ons rather than
tuck-ins, bolt-ons. So adding businesses that have other boxes to fit into our diagram, if you like, is a way of looking at it. But not the situation where we're buying a business that might be double the size that we are and all of that. There have been some spectacular failures in technology in this market where that's been tried. So
absolutely, a cultural fit is key in doing those sort of acquisitions.
Yeah, quite so.
Right.
So.
And then a question from Andrea. Do you expect to be able to announce more of the new customer pipeline converting to orders in the second half? I suppose with the economic conditions, are the sales cycles lengthening?
Not particularly. I mean, we've seen this quite big expansion in pipeline during the towards the end of the pandemic, but the pipeline remains strong through the pandemic. We're very close to the year end of second half now, so we're 10 days away from year end. So I think you'd have to draw your own conclusion as to whether anything else will be announced in the second half. Obviously, I can't say.
You can't say what's not announced. Yeah, of course. Yeah, so it'd probably be sensible to assume that it's more likely to come in the first half of next year rather than in the last few weeks of.
I think if you look at the backlog number that Andrew was talking about earlier, from the second half, where it was at 42 million, against a consensus forecast for this year of, I think, 32.8 or 9, sorry, 31.8 or 9, I think, Andrew.
Yeah.
And bear in mind that was at the end of the second half, and then going into 2023 with a consensus forecast of 39ish, I think, then that does put us in quite a strong position in terms of visibility, just on the basis of what's announced to date.
Yeah, absolutely. Well, thanks very much for that, Louis, Andrew. It was very interesting, and best of luck with the business. It looks promising out there. Thank you.
Thanks a lot, Mark. Thank you, and thanks everybody for attending. Thank you.